What is up, guys? Welcome to day 15 already of Anomaly sequence. Today we're going to be going over the concept of validating your data, validating your premises, going over your inferences, all that good stuff. I'm going to go over a couple of examples that you guys sent as well, and I'm going to be going over pretty much ways that you can kind of go over your data sources and all that good stuff, what you're going to be doing next, right? So this is just a very simple thought process as to how it works, what you're doing, when you're building up a thesis, when you're building up a concept, how you can then validate that, right? So to validate your premises and build a strong logical foundation for your trading system, you need to have data. I always say that there are so many different ways you can collect data, but you need to have something that you can fall back upon, right? That's also the main reason why with my students, I give them a track record, I give them an account that they can look at, that they can analyze, that I can analyze in front of them, that I can showcase, hey, your losing trades are way too quickly, you're getting tapped out way too quickly, or look at all the winners that you've taken. What are the simple parameters in that, in terms of SL distance, TP distance, time of day, all those different good things that you can have. Or when we look at the trade recap on its own, we want to be looking at the different things, the different parameters that you are implementing to validate your premises, right? You will have a narrative, you will have a strategy, you will have these things that I've mentioned as well, right? And we want to make sure that we can validate them now with data. There are different tools out there, write them down now, that I've used in the past, such as Edgeful, Rise Analytics, that can provide you objective and detailed insights into pretty much market behavior. They allow you kind of like on an algorithmic basis to quickly test your stuff very, very quickly and see whether or not they come over with your premises. But more closer to the traditional way is just backtesting and just really, really dumbing down on the results, meticulously collecting all that data. And it also helps you develop that deeper understanding on how the markets will react on different conditions. And it will allow you to build up that confidence with these premises. So you can do that with many different things, right? You can do that live, just handwritten, write it in front of you, piece of paper, and go over just the observations that you are doing, the premises that you've done, and then obviously the inferences that you've built upon those. If X does this, outcome Y, what are the odds, how often does it happen? Just tally these odds down. Very, very simple. You want to make it accessible, right? You want to have it just very, very clean, very sleek, to the point that you don't understand what could go wrong, right? You have the data in front of you, you're not giving yourself room for error. It just allows you to conduct your own analysis, which is very, very critical for your success. So kind of what it comes down to, right, is very, very easy stuff. So I'm going to go over a couple of these, right? We talked about how price moves from one liquidity pool to another, cheap areas to expensive areas. A way that you could go about testing this is just literally going on your H1, right? And make sure that so I'm giving you a little bit of a hint here. Understand and predefine what are areas that are considered cheap, what are areas that are considered expensive. This is what we identify with stuff like dealing ranges. Dealing ranges help us do that. You can see I'm already giving you kind of my experience to this. You're looking at different parameters, right? H1, H4. My best bet is dealing ranges work best on your flow parameters, your flow state, which is anything below daily up until your execution time frame, in my opinion, at least with the strategy that we trade, that we're all kind of similar with. H4, right? You can do stuff like this where you have lows. You've got these data lows. In this case, this is a data low being CPI, which is totally okay. I believe that's CPI. I might be mistaken with that. I'm not 100% sure now. Yeah, here, there you go, which is CPI. So on H4, it looks a little bit cleaner. You've got your dealing range, right? Something like this. You take it from the low to the high, and from there, this is pretty much your range, right? You can see how that becomes kind of your parameter, your first thing that you're looking at, right? If we just get it a little bit closer. So we're testing one thing, right? This is where your beginning of your playbook kind of gets made, and you've got a way of identifying dealing ranges, identifying your parameters. One of them is price moves from one liquidity pool to another, cheap areas to expensive areas. Okay. When we want to define stuff like liquidity pools, those are usually defined as the passive liquidity that lies above and below highs and lows. So above highs, right? This could be buy side liquidity pool, right? So price moves from areas that are considered expensive. Price is considered expensive here, above buy side liquidity pools, back into areas that are considered relatively cheap, right? Below the lows here, the lows here, the lows here. And that's kind of what we're seeing, right? Old highs, like what we've seen here, with all those highs at these levels, old highs and old lows will act as magnets on higher time frames. You go to the weekly, you can understand that that was a level here. As such, we go back to the 4 hour, you can see that that was an old high right here, just like that, right? So these areas are very, very interesting. Resting liquidity, passive liquidity above these areas. So suddenly we're adding all these premises into a nice strategy. And now often what you want to do is, how often does this happen, right? Okay, you check weekly high, how often does price tap into weekly highs? More often than not. What does your data say about this, right? If you're planning to learn a strategy from let's say my knowledge, you also need to test it out yourself, right? This happening just once isn't enough for you to solidify this premise, isn't enough for you to understand that this is something that we can validate, right? Overall, it's something that you want to be back testing, but also forward testing at the same time. That's one. We kind of did two here. So cheap areas to expensive areas, old highs and lows act as magnets. We've seen an example of that with the current market conditions as well. And now you can see that how we've sweep these levels, we've run liquidity here. We've done like a weekly wick, which is not ideal. We talked about that, but on the daily, we've got a body close above and below, trading above that high, going into an area where now we are kind of looking to see whether or not we'll be taking out these lows or not. How deep will this pullback be, and how prominent will this pullback be before we go back in sync with all this bullish momentum that there is. That's just me explaining the strategy, giving you a little bit of hints here and there. But let's go back to the logic aspect of things. So you have a premise. What you want to be doing is validating this premise. You want to be collecting this data. You want to be conducting your own analysis and understanding that you have these patterns. How often do these patterns occur rather than not? Sample sizes are very, very important. You want to make sure that you have enough data to do this. Back testing, so going into bar replay mode, allows you to click the candles a lot, right? It allows you to, on the click of a candle, get on the click of a button, get all the candles that you need in order to see all the data, which is totally fine, but it's not live marking conditions. So you want to find a balance between both. I don't necessarily say that one is better than another. They are totally equal in their own respect to the data that you can collect of them, if you manage to treat back-tested data as kind of like forward conditions, right? You can't have that emotional sense to back-testing, but you do just get confidence in your premises, in your inferences, in your logic building. If X does this, then I expect Y or Z. You're building your tool pretty much, where if these are your outcomes, right, then you keep going into an area like this is not a trade, this is not a trade, this is not a trade, and here you shoot based off of this variable, and this variable, right? And this is X, this is Y, and this is Z. If X does this, then it goes into Y. If that does Y, that does this. then no trade, no trade, no trade, and then here, boom, you shoot your trade. That is how you are building a trading plan. It can be simple as, do I have, and you need to decide if these filters right here are the ones that will eventually determine risk parameters, or if those will determine pretty much whether or not you will execute a trade, yes or no, right? It could be super simple. With all the knowledge that I'm already giving you, you can already build a plan based off what we see here, right? Understanding that we've taken out daily, has price taken out a weekly high or low? Yes, okay, cool. Then what does that do? Has price created potential arrays above that high or low? So we look on the daily and you can see that, okay, it hasn't in this case. Then, on the daily, has it created it on the H1, H4? Yes, it has, i.e. it has shown an imbalance to the downside. And then, can you play the pullback play? Is there a clear sell side draw on liquidity on the daily that you can target? There was, right? That was the shorts that there were here, which some of you guys played, which was very nice. Is it an array? So when we talk about arrays, we talk about order blocks and we talk about imbalances. Those are your two main arrays. Those are internal liquidity. Then you talk about highs and lows. Those are your buy side and sell side liquidity. Those are not arrays. Arrays is everything that you use to trade from arrays into highs and lows. Okay? I think that makes most sense for you. Arrays is everything between highs and lows that is valid to trade into or away from. Price moves into arrays and away from arrays. Inducing arrays or mitigating arrays. Inducing is taking them out, mitigating them is respecting them. You see how I'm giving you all these parameters that you can be using in your thought process in order to develop this logic group. So again, you see that this is kind of like the logic tree that you need to be implementing for you, like this waterfall method. Go into more details, right? We've got another one. If price trades back into the imbalance, then it will most likely fill it, at least partially, before resuming the overall trend. Very, very good. Not a bad understanding there. Ask yourself, which time frame? Higher time frame more often than lower time frame. H1 imbalances versus M15 imbalances. Add parameters to them that make them a little bit more consecutive, a little bit more concise to follow. Another one, if London session sweeps Asia high, then it is likely to reverse and run towards Asia low. This is a very, very easy one that you can test, back test every Asia high, and ask how many times on that same day does it sweep Asia low. And suddenly, you've got these building blocks, right? And what you're doing and what you want to be doing is adding all these building blocks together to see which one is the most probable, right? Which parameters tend to be the most efficient. So, hey, am I in bullish daily order flow with weekly order flow? Asia low sweep into Asia high off of an H1, H4 array, such as an order block or an imbalance, then suddenly you're stacking all these confluences together. You've data tested them, you've got data upon these, and you know that that is a high probable scenario. Not the other way around, that you've got an entry model of, hey, I'm just playing a market shift here off of M15, but you've got no backing of, oh yeah, shit, I've actually got so many other parameters which are better. Start adding those together. So validating. So create these premises. We will be going over more and more as I go by. I'm already giving you hints in this video as well of ways that you can combine them. What you want to be doing now is validating them. Validate your logic, validate your findings, backtest them live markets. I'll show you how you can backtest them, sure, maybe later down the line, but it shouldn't be rocket science that with these findings you understand, hey, what are my parameters? What are all the things that I'm looking at, right? We've got a couple of good ones that we mentioned in this video. Liquidity pools, cheap versus expensive, right? Stuff like premium to discount, right? Stuff like here, we're in premium, here we're in discount. In discounted, it's more favorable to look for buy side. Okay, ask yourself, how many times have you created a dealing range like this And after that, you've created a dealing range like this. Does price go back from just anywhere in this to that area, and vice versa when we're here back into that area? And then this is a really cool one. This is one that I use. How often enough do you play this range, right, before you start targeting external? For me, it's roughly 2 to 3 times. You can play a dealing range 2 to 3 times on H1, H4 before you should be looking at external. That's just data driven for me. But what can you also see? If price creates bearish arrays here, right, I will be looking to trade external. So I will be taking shorts in discount. What's my data on shorts in discount? What's my data on playing M15 shorts in discount after I've taken major levels on the higher time frame? Oh, it's actually quite favorable. That is a decent counter stage play that I can play against my daily, my monthly higher time frame narrative. Why? Because we've taken out this huge area of passive liquidity. Does it slowly start to click for you guys? This is the way that you need to think of it. Your strategy, your edge is a thought process. It's not just plug and play. You need to understand the scenario where you are in with price by understanding liquidity, current liquidity, the state of liquidity, and then from there build it down with all these different parameters that you have. And just like that, you understand and you crunch through it. So I hope that again, just creates little aha moments. I hope just some aha moments that you guys can understand and implement into your own logic thinking. Once we get with more variables, I'll be giving you a lot more examples. Don't worry about that. But I also just need to make sure that one, you're technically up to speed with my understanding, your liquidity concepts are up to speed with my understanding, and from there, we're breaking it down with potential strats, plays, playbooks, case studies, and all that good stuff. But today, main emphasis is understanding that you need to validate your data. And I've given you tools such as Edgeful, Rise Analytics that you can use yourself to validate data, to test around, or just go to the manual route where I said backtest, journal. Those are the 2 ways. Do it the old-fashioned way. Write it down, pen and paper, go for it. So I hope that helps, and I'll see you guys in the next day on Anomaly sequence.